What's up, investors? Today, we're covering the basics of options trading for those who have zero experience. Don't worry. I'll explain everything in plain language without complex math or jargon. Options may seem confusing at first, but they're simply contracts that give you the right to buy or sell a stock at a predetermined price. By the end of this video, you'll understand why investors use options and how to trade the two main types, calls and puts. So let's get started. What are stock options? A stock option is a contract between a buyer and seller to facilitate a potential trade, involving an underlying stock at a preset price and date. As the option buyer, you pay an upfront premium fee for the right, but not obligation, to either buy shares, call option, or sell shares, put option, on or before the expiration date. Depending on how the stock price moves, the seller or writer of the option collects that small premium payment upfront for taking on the obligation to buy or sell the shares at the predetermined price. If the option buyer exercises their contract rights, whether you choose to exercise that right to buy or sell depends on if it makes financial sense, given where the underlying stock price ends up by expiration. Call options explained. Let's start with call options, which you buy if you think a stock will go up over a period of time. You pay the option premium hoping the share price will rise above the strike price by expiration, making it profitable to exercise your right to buy the discounted shares. Example, Amazon stock is trading at $100 per share. You expect it to rally over the next 6 months, so you purchase an Amazon $100 call option, expiring in 6 months for a $5 premium, representing $500 total for the contract covering 100 shares. If Amazon stays at or below $100 by expiration, your call expires worthless and you're out the $500 premium paid. Not ideal, but your maximum risk is defined as that upfront premium cost. But if Amazon rallies to, say, $120, you could choose to exercise your call option and buy 100 shares for the $100 strike price, immediately capturing $20 in upside per share. So that's $2,000 in profit against your $500 premium paid. Not too shabby. Alternatively, you could just sell the now in the money call option itself for an instant profit without dealing with purchasing shares. So in essence, calls provide upside leverage on a stock while capping your maximum risk to just the premium paid if the trade doesn't work out. Put options. Now let's look at put options, the opposite of a call. These give the buyer the right to sell shares of a stock at the strike price anytime until expiration. Puts increase in value when the underlying stock drops. The lower it goes, the more profitable it becomes to exercise your put option to sell those overpriced shares. Example, Tesla stock is trading at $200. Based on your research, you think it's headed lower over the next couple months, so you buy the Tesla to $100 put option expiring in 60 days for $10, representing $1,000 premium for the standard 100 share contract. If Tesla is below $200 at expiration, you can exercise or sell your now in the money put for a profit. For each dollar below $200, the put increases in value. Say Tesla falls to $180 at expiration. You could exercise your put, selling 100 shares at the higher $200 strike price for a $2,000 profit against your $1,000 premium paid. Simply keep the $20 per share difference. Or you could sell your option contract itself on the open market for its intrinsic value, reflecting the $20 in the money amount, likely just taking that cash profit and going about your business. However, if Tesla stays above $200 at expiration, the put expires worthless and you lose your $1,000 premium as the max loss. The lower the better on puts. Like calls, puts offer leverage and defined risk. You get to essentially temporary control 100 shares, with a fraction of the capital required to own the stock outright. Now pause the video right here and drop me a comment. If this simplified example helped, explain calls and puts better than your previous understanding, I want to make sure this clicks before we keep going. Alright, let's continue. Risk management tips. So with all this leverage and flexibility comes added risk. Beyond just share ownership, to trade options responsibly. 1. Always define your maximum potential loss and make sure you can withstand that worst case scenario. Both financially and emotionally, options can and will expire worthless at times. So you need to stomach those losing trades. 2. Use reasonable position sizing. A good rule is risking no more than 1 to 3% of your capital on any single options trade. 3. Have an exit strategy. Set price targets to lock in gains or cut losing trades early. Based on changes to your directional outlook, don't just watch profits dwindle and losses balloon out of hope. 4. Maintain ample reserves. Don't over-leverage your capital by having too many positions on at once versus how much dry powder you keep on the sidelines. 5. Continue educating yourself. I've covered the very basics here. Never stop learning. Start with paper trading. The smartest way to begin options trading is using a paper money simulated account first. Nearly all brokers offer paper trading platforms nowadays. Use a fake $25,000 or $50,000 and practice buying, selling various options strategies for a few months risk-free. This will help you build experience analyzing options chains, entering and exiting trades, and dealing with the emotional aspects of managing winners and losers. You'll make plenty of mistakes in this paper trading environment, rather than risking real capital early on. Once you start consistently profiting and truly understanding the mechanics of options, then you can transition to a small, real money options account. I cannot stress enough the need to crawl before you walk, and walk before you run in this options trading world. The risks can be immense if you don't have a clue what you're doing. So take it slow, get experience on paper first, and make sure options mesh with your personality, risk tolerance, and financial goals before diving into this leveraged universe for real. The bottom line, I hope this Ultra Basics video was helpful to provide you a simple introduction to options trading for beginners. Let me know in the comments if you still have any lingering entry-level questions about stock options, and please drop a like and subscribe to my channel. If you want to see even more options guides, trading tutorials, and advanced strategies broken down visually. Until next time, happy trading!